90% of traders fail because they can't read Fibonacci signals correctly. Today it's time to finally discover how to use Fibonacci effectively in any market condition. Fibonacci's effectiveness depends on how you apply them, and the key is to use them on the correct price swings. When you're looking at a price chart, you'll see many price swings. You might connect 2 points on the chart that seem significant to you, but another trader might choose different points. This doesn't mean one of you is wrong. It just highlights the subjective nature of this tool. To apply Fib retracements correctly, you need to start by determining the dominant trend. Once you've identified the trend, your next step is to find the most obvious swing high and swing low. These are the points you'll use to draw your Fibonacci lines. In a bullish trend, you'll draw the Fib retracement from the swing low to the swing high. This makes sense because in an uptrend, you're looking for potential support levels where the price might pause or reverse during a pullback. In a bearish trend, you'll draw from the swing high to the swing low. You're looking for potential resistance levels where the price might stall or reverse during a bounce. When drawing these lines, it's important to use the wicks of the candlesticks for your swings, not just the bodies. The clarity of your chosen swing points is probably the most important aspect. The clearer the swing low and high, and the more defined the trend between these points, the more reliable your Fib levels are likely to be. One common mistake is trying to force Fib levels to fit where they don't naturally apply. Remember, not every price move will align perfectly with Fib levels, and that's okay. The most helpful Fib retracements are those that are obvious on the chart, without much effort to spot them. If you find yourself squinting at the chart or trying to convince yourself that a level fits, it might be best to look for a clearer setup. When applying Fibonacci retracements, think about the market structure. In an uptrend, for example, you might look for buying opportunities near these Fib levels as the price pulls back. The idea is that the trend will eventually continue, and these retracement levels offer potential entry points at a better price. Number one rule is that Fibonacci levels work best in trending markets. Without a clear trend, these levels lose their significance and impact on price movement. When you spot a trend, look for the logical price swings to place your Fib retracement tool. This step is critical and often where most traders struggle. The trick is to find the most relevant high and low points that represent the current market conditions. So in this uptrend, I would draw the Fib retracement from this swing low to this swing high. For this downtrend, I would draw it from this swing high to the swing low. Once you've placed your Fib levels, you'll notice several key retracement levels. The most commonly used are 23, 38, 50 and 61% levels. These lines can act as potential support areas in an uptrend or resistance zones in a downtrend. Many traders focus primarily on the 61% retracement level, as it's often considered the golden ratio, but I wouldn't discount the power of other levels. In strong trends, price might only retrace to the 38% level before continuing in the trend direction. In weaker trends, price might extend to the 78% level. Now, it's worth noting that these Fibonacci levels don't act as exact support or resistance points. Instead, they help you find areas where price might react. So think of them as zones rather than precise lines. Remember, Fibonacci levels often become self-fulfilling prophecies in the market. Many traders watch these same levels. This collective action can create real support and resistance zones. And please note that Fib levels struggle in sideways or ranging conditions. If the market is consolidating, it's often better to wait for a clear breakout before applying a Fibonacci analysis. Here's another common mistake. When you apply Fibonacci retracements to very small price moves or shorter time frames, you might run into some issues that can make your trading less effective. Think about it this way. On shorter time frames, price movements are often more erratic and less significant. These small, rapid price changes don't always reflect the true market trend or important levels. When you try to use Fibonacci retracements on these short-term moves, the levels you get are often too close together. This closeness makes it hard to tell which levels are truly important and which are just noise. Another problem with using Fibonacci on short time frames is that you're more likely to see false breakouts and price spikes. These quick, sharp moves can trick you into thinking a level has been broken when it hasn't really. This can lead to poor signals, like entering a trade too early or exiting one too soon. Think about it. Stops and take profit points are key for managing your trades. But when you use Fib retracements on short time frames, it becomes tricky to place these effectively. The retracement levels are so close together that they create narrow confluences. This means there's not much room between levels, making it hard to set stops that protect you from normal market noise, while still giving your trade room to breathe. So what's the solution? Focus on larger time frames when you apply Fib levels. You get a clearer view of the long-term trend. This helps you apply Fibonacci retracements in the right direction, aligning with the overall market movement. When you use Fib retracements on larger time frames, you're looking at more significant price moves. These bigger swings are more likely to represent important market levels. The levels drawn on these larger moves are spaced further apart, making it easier to see which levels might be important. And you don't have to stick to just one time frame. You can use a multi-time frame approach. You might start with a larger time frame to find the overall trend and major Fibonacci levels, then zoom in to a smaller time frame. Another benefit of placing Fibs on larger time frames is that it can help you avoid overtrading. When you focus on smaller moves, it's tempting to take many trades, thinking each small retracement is significant. But by zooming out and looking at the bigger picture, you can be more selective with your trades, focusing on the moves that are more likely to be significant. When we talk about retracements, we are looking at how much a price pulls back after a strong move. These pullbacks can be shallow or deep. Shallow retracements happen in strong trends. When a market is moving with conviction, it doesn't pull back much before continuing its journey. In these cases, you'll often see the price only retreat to the 23 or 38% areas. The trend is so strong that it doesn't need much time to refuel before zooming off again. When you spot these shallow pullbacks, it's a sign that the trend is healthy and likely to continue. Deep retracements are more common when a trend isn't fully established yet. The price might make several ups and downs, testing previous highs or lows without breaking them. Deep retracements often reach the 61, 78, or even 88 Fib levels, and these deeper pullbacks can be tricky. They might make you think the trend is over, but it's not always the case. It's more like the market is taking a longer break, perhaps reassessing its direction before deciding to continue. The key difference between shallow and deep retracements is in what they tell us about the strength of the trend. Shallow retracements signal a strong, confident trend. The market barely hesitates before pushing on. Deep retracements suggest more uncertainty. The trend might still continue, but it's taking its time to gather strength. If you see a shallow retracement in a strong trend, it might be a good opportunity to join in the direction of that trend. With deep retracements, you might need to be more cautious. While they can still lead to continuation of the trend, there's also a higher chance the trend might be losing steam. and if the price retraces 100% of the last move, it might be a sign that the trend has failed. Now, when price reaches a Fib level, look for specific candlestick patterns. These patterns can confirm if the level is likely to hold or break. It's like getting a second opinion before making a trade. There are a lot of candlesticks, but the most useful patterns at Fib levels are engulfing patterns and candles with long wicks. Candles with a long lower wick show up at the end of a down move. This long wick shows that sellers tried to push price lower, but buyers stepped in and pushed it back up. When you see it at a Fibonacci support level, it might mean the down move is over. If you spot a candle with a long upper wick at a Fibonacci resistance level, pay close attention. They often signal the end of up moves. Buyers try to push price higher, but sellers to control. Engulfing patterns are also decent signals. In a bullish engulfing pattern, a large green candle completely covers the previous red candle. This shows buyers taking control from sellers. A bearish engulfing pattern is the opposite, with a large red candle covering the previous green one. These patterns at Fibonacci levels can be strong reversal signals. From my experience, using candlesticks with Fibonacci levels works best on longer timeframes. This is because bigger moves tend to respect Fib levels more, and candlestick patterns on longer timeframes often carry more weight. Let's say price is in an uptrend and pulls back to the 50% Fib level. This level acts as a potential support. If you see a candle with a long candlestick forming right at this level, it's a decent sign that the pullback might be over. The Fib level shows where buyers might step in, and the candle shows that they actually did. Here, price is in a downtrend and bounces up to the 38% Fib level. This level will act as a potential resistance in a downtrend. If an engulfing candle forms here, it implies the bounce might be over. So the Fib level shows where sellers might return, and the engulfing candle shows they're actually taking control. These engulfing patterns at Fib levels show a sudden strong shift in who's controlling the market. And an engulfing pattern that completely swallows several previous candles at a key Fibonacci level is hard to ignore. Volume can add another layer of confirmation to candlestick patterns at Fibonacci levels. A reversal candle with high volume at a Fibonacci support level is more convincing than one with low volume. The high volume shows strong buying interest, right where buyers were expected to step in. Now, one common mistake is to focus only on exact Fibonacci levels. As I said, in reality, these levels are more like zones than exact lines. A candlestick pattern doesn't have to form exactly at a Fib level to be valid. If it's close, it's worth paying attention to. And another key point is to look at the bigger picture. A candlestick pattern at a Fib level is more meaningful if it aligns with the larger trend. For example, a bullish pattern at a Fibonacci support level in an overall uptrend is typically stronger than one that goes against the trend. The golden zone method is a smart way to trade using Fibonacci levels. This method focuses on the 50 and 61% area, which we call the golden ratio. First, you find a clear trend in the market. You then apply Fibonacci tools to this trend. You've practically marked the key levels where the price might turn around. The strategy gets interesting when the price starts to move against the trend, when price starts going up. You watch closely as it moves past the 50% Fib level. The key is to see if the price can break and close above the 61% level. In the perfect scenario, the price reaches the zone, but doesn't close above it, and this could be a signal that the downtrend is ready to continue. In the real market, the price will touch and even go a bit above this area. but this doesn't invalidate the setup. So it's okay if the price goes above the 61 line. Once it returns below it, that's a good sign for our strategy. This moment is when we get ready to make a move. We are looking for signs that the price is about to turn back down. Maybe it's a bearish candle forming, or other factors lining up. The idea is to catch the market just as it's deciding to follow the original trend again. In this chart, once we see the price bounce off the golden zone, we start looking for a move back up. The next target might be the 38% Fibonacci level. If the price breaks above the 38% level, it could mean the previous uptrend is picking up steam again. After the 38% level, the next stop might be the 23% level. This is another place where the price might pause or bounce a little. But if the uptrend is strong, even this level might not hold. In that case, we could see the price go all the way back to where the downward move started. We call this a 100% retracement. So these Fib levels aren't just targets for where the price might go. They're also useful for managing your trade. You can use these levels to decide when to take some profits. For instance, you might decide to sell a part of your position when the price hits the 38% level and more at a 23% level. If the price never got higher than the golden zone, you might put your stop loss just above that line. This way, if the market suddenly changes direction after you entered, you're protected. Combining multiple Fib retracements will help you find stronger trade setups. Start by looking at the big picture. Draw Fibonacci retracements on larger timeframes, like the daily chart. This shows you the main trend and important levels. Then zoom in to smaller timeframes, like 1-hour charts, and draw Fibonacci retracements there too. After that, you might see some levels from the bigger timeframes, matching up with levels on the smaller timeframes. These matching levels create confluence. For example, the 38% Fibonacci level on the daily chart might line up with the 50% level on the 1-hour chart. This overlap becomes a strong area to watch. It's like two different paths leading to the same place. These levels often act like magnets, pulling the price back before the main trend continues. It helps to watch how the price acts when it hits these Fibonacci levels. Does it pause? Does it turn around quickly? These reactions can tell you how strong the level is. So this technique is all about finding areas where different Fibonacci levels from various timeframes overlap, creating a strong support or resistance level. In this case, we see a confluence where the 61% Fibonacci retracement from the 4-hour timeframe meets the 38% retracement from the daily timeframe. This overlap creates a buy zone that's much stronger than a single Fibonacci level alone. The power of this approach comes from the fact that traders using different timeframes will all see this area as significant. Those looking at the daily chart will see the 38% level, while those on the 4-hour chart will notice the 61% level. When both groups see the price reacting at this zone, it can create a self-fulfilling prophecy, increasing the likelihood of a bounce. Combining Fibonacci retracements this way helps filter out weaker setups and focuses your attention on the most promising trade opportunities. It's not just about drawing lines on a chart, but about building a complete picture of potential market turning points. In this example, the price pulled back to the confluence zone and found support there, which is exactly what we look for in an uptrend. In this chart, we see another example of confluence. Two different Fibonacci retracements, drawn on different timeframes, have aligned at the same price area. This creates a strong resistance zone, setting up a potential selling opportunity. In this case, we see a confluence between the 4-hour 38% level and the 1 hour 50% Fib level. This is a key resistance zone where sellers might enter the market in a previous downtrend. And indeed, this zone acted as a ceiling where price struggled to break through, then change direction. Fibonacci and moving averages combo is also a viable method. When used together, they create a synergy that can confirm your signals. Fibonacci alone can point to possible support or resistance levels, but they lack the weight of confirmation. This is where moving averages step in, adding an extra layer of validation to your analysis. Moving averages serve two key purposes in this partnership. First, they help you spot trends. A simple look at the slope of a moving average can tell you if the market is trending up, down, or sideways. And second, moving averages act as dynamic support and resistance. As price moves, these lines shift, creating flexible barriers that price often respects. And when a Fibonacci level lines up with a moving average, you've found a spot of confluence. In this example, price has been climbing steadily. You draw your Fibonacci retracement from the recent low to the high. The 50% retracement level catches your eye. Now you notice the 200 period exponential moving average is sitting right at that same level. This is confluence in action. The Fibonacci tool and the moving average are both pointing to the same price area as significant. This confluence increases the odds of price reacting at this level. You might see price pause, bounce, or even reverse at this point. It's not a guarantee, but it's a strong hint from the market. This combination is powerful because Fib retracements can sometimes seem arbitrary, and moving averages on their own can lag behind price action. But together, they create a more robust analytical framework. And it's not just about finding potential trade setups. It's also about understanding structure. These confluence points often mark key levels where big players in the market might be active. It's also worth noting that different traders might use different Fib levels or moving average periods. Some traders swear by the 61% level combined with the 200 period moving average. Others might prefer the 50% level with the 50 period average. The key is to find what works best for your trading style and the markets you trade. Now let's talk about how volume can confirm Fibonacci levels. When price reaches a Fib support area, I always look at the volume. Volume is like the heartbeat of the market. When price goes up, you often see big spikes in volume. It's like a lot of people getting excited and jumping on board. But what happens when price pulls back to a Fibonacci support level? This is where it gets interesting. If you see volume getting smaller as price pulls back, that's a good sign. It means fewer people are selling. It shows that most people who wanted to sell have already done so. There's not much selling pressure left. Now you might think low volume means people don't care about the market anymore. But that's not true. It just means there are fewer sellers. Smart buyers see this as a chance to get in at a good price before everyone else notices. So watch what happens after price bounces off the Fibonacci level. If you see a big jump in volume, that's a very good sign. It means a lot of people are suddenly interested in buying. This high volume after a bounce is like a green light. It shows that the Fibonacci level worked as support, and now more people are jumping in. It's a sign that the upward move might continue. Using volume with Fibonacci levels also helps you spot fakeouts. Sometimes price might dip below a Fibonacci level, scaring some traders. But if volume stays low during this dip, it might just be a trick. The real move could still be upwards. So when you see price approach a Fibonacci level with declining volume, get ready. This could be a great entry point. But don't jump in just yet. Wait for that volume spike after the bounce. That's your confirmation. This method works in downtrends too. If price is falling and then hits a Fibonacci resistance level, watch the volume. If it drops off as price goes up to the level, sellers might be running out of steam. A big volume spike downwards after touching the level could signal more downside to come. One of the most underrated ways to trade Fibonacci levels involves divergences. A divergence is a leading trading signal, and it can help confirm if a price reaction is likely. It's simple. Just choose a momentum indicator. I prefer to use the MACD. This indicator shows if a trend is strong or weak. Yes, it lags, but we don't need crossovers or other signals. We simply look at inefficiencies between the price and the oscillator. When MACD don't match what price is doing, it's called divergence. And as I said, a divergence at the Fibonacci level is a strong sign of a possible reversal. Let's talk about how this works in a downtrend. Imagine price hits the 50% Fib level and starts to reverse. Then you look at your oscillator. If price is making higher highs, but your indicator is making lower highs, that's a divergence. It means the upward momentum is slowing, even though price is still trying to move up. This implies the bounce might be over and the downtrend could resume. The same idea works in uptrends too. Let's say price is rising and then pulls back to the 61% Fibonacci level. If you see a divergence on your oscillator right at this level, it's a strong buy signal. The signals are called leading indicators. They hint at what might happen before price actually turns. That's why they're so valuable. They give you a heads up, letting you prepare for a potential trade. Of course, a divergence at Fibonacci levels doesn't guarantee a reversal. It just makes one more likely. You could look for the other signals we've discussed, like candlestick patterns or volume changes, to confirm the signal. Probably my favorite strategy is to look for confluences between the Fib levels and supply or demand areas. It doesn't happen often, but when it does, it can be a sign of something special. In this example, notice that the price is approaching a key demand area that lines up with a Fib level. That's a confluence perfect for a trade. If the price bounces off that area, it could be the start of a beautiful uptrend that you can ride. On the flip side, if you see the price approaching a major supply area and that coincides with a Fib level, it could be a sign that the buyers are about to run out of steam. If the price gets rejected at that level, it might be time to start hunting for short opportunities. Let's talk about demand areas first. These are places where lots of people want to buy. When the price gets near a demand area and it's also close to a Fibonacci level, it's extra special. This tells us that the price might start going up soon. Think about it like this. You're looking at an uptrend. Then the price is going down. But then you notice it's getting close to a demand area. The price is also near a key Fibonacci level. You may want to monitor closely this area. Supply areas are spots where lots of people want to sell. When the price climbs up to a supply area and it matches a Fibonacci level, it's another special moment. This might mean the price is about to turn around and start falling. Picture this. The market is in a general downtrend. Then the price has been climbing for a while. Then you see it's approaching a supply area. The price is also near an important Fibonacci level. This is when you start thinking the upward move might be running out of steam. These confluences are like secret messages in the market. They don't happen all the time, but when they do, you pay attention. Here price bounce off a demand area that lines up with the Fibonacci level. This is a good time to enter a buy position and ride the price up as it starts a new upward move. And here, price hit a supply area that matches a Fibonacci level and then start to fall. This was a good time to sell as price started a new downward move. Now, if you're ready for more interesting trading guides, go ahead and watch one of these videos.